Hello, everybody. Hey, guys. Thank you very much for joining. Hey, Joe. Hey, Tian. Nice to see you guys again. Welcome to another episode of the Keyword Podcast. Today we have two individuals from the digital asset industry that don't need no introduction with us today, representing two of the most influential companies in the digital asset space. Considering we're talking today about on-chain asset management, we have today with us Joe Flanagan, co-founder and CEO of Maple, and Tian Lee, CEO of Pendle. Welcome to the space, guys, and we're gonna try to get started already with some interesting topics to keep it entertaining. Considering that you're already quite popular in the market, I'd like to maybe get started something simple. What is your view on the current state of looping in the market? How dangerous is it? How critical is it? And how big is it? Let's go. Who wants to get started?
Tian has to take that one first. And you've hit him hard to start with, so go ahead, Tian.
All right. I think it's become a very essential strategy from a yield opportunity standpoint. I think it's quite meaningful because with a base yield of something like say 8 to 10%, with several rounds of looping, you can really drive out the yield to 17-20%. And from my perspective, the the risk is actually quite manageable if you're not overdoing it because let's say in this case, right, for looping, I'm going to use PT as an example, along with a money market. A PT is deposited as a collateral on a money market to borrow another stable coin and then use that stable coin, buy PT again on Pendle, and then deposit that into a money market as collateral once more, and then borrow stablecoin. Because over time, PT will realize into the value of an underlying towards maturity. So it's I think because the assets are very highly correlated, the risk, if you're not overdoing it, is very manageable. And we've seen the effectiveness of this. The fact is, like, at its peak, PT assets represent about $6 billion of TVL on Aave, which is probably around like 25%, maybe a quarter of Aave's TVL. And it has grown that segment quite a fair bit. So I think it's quite an essential vertical there.
How much of it do you see, Joe? Is it like also?
Yes, I mean, I probably have a bit of a different perspective. I think that there's two main things here. One is that I don't think it's recognized for people that aren't like deep DeFi users how much leverage there is in the system, right? And so I think you could go and do the on-chain analytics, but an average looper is doing anywhere between 4 and 6 loops. And so that means that, you know, when we represent that there's 6 billion of PTs sitting in Aave, there's really a billion of principal that's there, that's then being looped 5 or 6 times to get to that 6 billion total. So I don't think that that's broadly understood. When people go to the Athena TVL and they see 14 billion, how much of that is looped leverage that gets to that number? So I think that that's one distinction between a deep DeFi user and someone just observing it. Then the other is it all comes back to the quality of the underlying asset. And so if there's ever anything that is an issue with that underlying leverage, then effectively you have these kind of like, you've actually broken things up into kind of a senior tranche and a junior tranche. You have the senior tranche, which is people that are just the one-time depositors into that underlying asset. And the junior tranche are the ones that have leveraged exposure to that underlying asset. And so I think that as long as those people understand the increased amount of loss risk that they're taking, then I think this is okay. But I don't think that there is a good understanding of that underlying risk, and that there is this increased exposure. They go, okay, like it seems this asset is principally protected, therefore I can just loop it as many times as I want to, not really understanding if there was any loss, the amount of underlying impact that they're going to receive from that. And so from Maple's perspective, like that's our real responsibility, is the quality of that underlying asset that we're bringing into the space, and enabling all of these new financial primitives and things like looping to sit on top of it, knowing that underlying asset is strong, secure, and consistent yield.
That's actually super interesting. So in your view, is something around, in average, 6 times. Okay. If you would try to give some advice to the listeners about what would be the best way for them, or what statistics should they use to track the level of leverage of the market for them to know if there is danger or not, what would you suggest? What do you think people should look at?
Good question. I have a data guy, and he tells me, and so I don't know exactly what he's looking at, but maybe that's something we can follow up. Like we can call it out in the show notes. Like this is where you can track it on chain.
I think we should, correct? I mean, it's very interesting. I think it will be very useful for everybody.
But to my point, right? It's not like broadly disclosed. Like here's the amount of morpho looping that exists. But I think you can make the like you could probably trace it all back, right? And so you can do it at an individual wallet level. But how we can get something of like, here's the average looping per asset to understand the amount of leverage that exists on that asset. Because it is a
build that real UI of Pendle. What do you think about that?
Say that again.
Should maybe build it in the UI of Pendle, some little like information about the state of leverage in the market.
You can talk to the man who controls the UI.
Maybe. Yeah.
Okay, thank you very much for that, guys. Sorry for putting you on the spot with the first one. Let's go back to slightly back to the beginning. The on-chain asset management space is really booming. It's very interesting to see what has happened. I would say compared to a few years ago, where I would say vaults were in its infancy, there was not much liquidity going in the market, to today we see 35 billion of AUM within different asset management products. We still see majority of those products to be more towards the credit space than other type of asset management products. Hopefully, some of them will come in the future. So I wanted to get started just with your view on why has this happened? What is the state of the market? And most probably leveraging the capacity to leverage these RWA assets is one of the reasons. But wondering, what else do you see that has triggered this growth of on-chain asset management, and what will continue to be the main drivers for adoption?
Yeah, so I mean, from our side, we see. I think that the launch of Morpho V2 was a real step in the direction of asset management on chain, and we actually like kind of started with this model back in Maple V1, where you have this idea of underlying infrastructure that then asset managers, credit underwriters can come and leverage and use that on-chain infrastructure to run some sort of asset management business. And that is now just proliferated to a whole nother level, where you've got everyone's wanting to launch and manage vaults and be a curator and kind of sit on this layer to be able to allocate capital across the DeFi space and be kind of viewed as a professional DeFi asset manager. And that they're able to get unique TVL deals, they're able to get unique incentive packages, and be able to allocate capital. The only thing I would call out there is that it's all kind of happening at this layer up here. And a lot of it is farming points or token incentive programs. And that's where the kind of alpha generation of curators and asset managers on chain is happening. There's very little that's happening at the primary layer to either issue actual credit strategies or to bring actual yield into the space. The way we think about it is there's maybe 3 main yielding primitives across the DeFi space today. There's Maker and everything that happens around the Maker ecosystem. There's Athena and the basis trade, and we've seen how well that's done. And then there's Syrup USDC, Syrup USDT, and over collateralized institutional lending. There's not really many other underlying yield primitives that are then coming into the space to be built on top of. And so that's what I want to, we want to ensure is that not everything's just happening at this like farming layer where everyone's trying to aggregate TVL to go farm points, and that there's real yield uses, real allocation of capital that is not only just generating yield but actually furthering the space, right? Because where we allocate capital is how we allocate what's going to grow. And so if that's all going to points programs, and that's going to be the only thing that grows. Whereas if this is to actual yielding solutions that are allocating capital to real things, then that's going to be super beneficial to the space and enable the whole DeFi ecosystem to grow.
You look at those three categories that you mentioned, Greg. I mean, they all, in one way or another, are in the credit space, in a sense, correct? Like they are relatively principal protective strategies where you expect a yield, which has enabled then TN here to be able to strip those products and give an additional utility to these products in the market. Could this be the reason why other products that might have a very good return profile, but they might have drawdowns, are not attractive yet in the market, as people would just not know how to control the risk of these products? What do you think, Tian? Could you start stripping some things with a slightly more asset management or let's say alpha style strategies?
Yes, we have actually looked into it. So historically, I think up until recently, we've been primarily focused on up only assets. So like let's say if you an up only asset would be yeah, something simple like um, a tokens on Aave.
Yeah.
But over time, we're seeing vaults that are properly managed. Um, Maybe over a long period of time, they can return positive yield. But during certain periods, before the end of the tenure, they could potentially dip into the negative territory. So we are now working on a system to support assets that could have fluctuating yield, especially dipping below zero. So yeah, this is an area that we want to address, and we will have a solution for.
This is interesting. Is this still confidential? Can you tell us a little bit how it works?
Um,
Thinking about it.
I think more of that to come later. Yeah.
Okay, I'll give you a beer for that.
But something like that one would be very interesting for you guys as vol traders, right? Like if you had a vol strategy that you were running, you could have a daily drawdown in a vol strategy of 8-10%. And so but TN and Pendle's product is entirely is the whole primitive relies on that volatility in the yield. And then what he's built from an innovation perspective is pretty incredible to enable products to sit on top of that volatility.
I'm gonna have to catch you on that later. Absolutely. One of the assumptions that we have in the market right now is that this growth of on-chain asset management is still predominantly driven by retail at the moment, or let's say by digital asset power users. What do you think changed? Like, why are users starting to seek third-party managers to manage their capital? Correct. In the early days of crypto, these products didn't work, also just because everybody thought that they could do it better themselves. Correct. What have you seen in the market?
I think it's really just over time, people learn from mistakes and realize that like maybe they're not suited to like I think markets can be very very humbling at times. When I was younger, I used to think that I could beat the market. Well, like what I could make like 20-30% easy until like certain events that took place, and then I was back to square one. So because I believe quite a fair number of people have been through some cycles already, and that like those experience could form and shape a view on like risk management. And then tools like ours also became more relevant, because I also think like fundamentally people care about certainty. so for one, if there's a way, if like as a user, right? Um, I if I want to manage my yield, I need to know how to manage my risk. Just given my previous experience getting burned because of market events and activities, and then if I'm not capable of managing that, then I might be better off just assigning my asset to someone else who can do it for me at a slight cost. But overall, I could still be net up.
So the thesis here is DeFi degens lost money multiple times until maybe they now giving it to the asset managers, and that's why this is that now this is finally picking steam and AUM. Makes sense, correct?
Some users. Yeah.
I've thought that has to be I cannot prove it, but I would agree that it has to be one of the reasons.
I'd add a couple other things. I think one is that increasingly protocols want to deal with one or a limited number of counterparties, and so it speaks to doing TVL deals, doing incentive deals with one counterparty that's then facing many users from there, and so it just makes it much easier from a incentive management perspective. Then the other is that the space has just gotten much more sophisticated. If you want to be like getting into these opportunities, if you want to be maximizing yield across DeFi, like you need to be running bots, you need to be running sophisticated strategies. It's not just kind of someone sitting at their screen, kind of farming Wi-Fi, right? It's gone to a whole nother level now, and a good example of this is the pre-deposit vaults that have like launched with Plasma, and so these things are getting filled in like 2 blocks. Crazy. And so if you're not botted up and sophisticated manager, then you're not getting access to these deals. And so I think that's what people are starting to recognize. And so either you're a sophisticated DeFi hedge fund that's doing it yourself, or you're less sophisticated, allocating into a vault and letting a manager do it for you.
I wholeheartedly agree with what Joel said. Yeah. So it's like
is a scenario, where do we end up end of the year, correct? So if we are, let's say we're at 35 billion now, do we double in the next 3 months? Is it possible? Tough question. But definitely, in our report, we bet that it will get to 60 by the end of the year.
Yeah. Well, Maple will be doubling in that time, so we'll be doing our part. I can't speak to everyone else.
Thank you, Joe. That's great. Cool.
Nice.
I wanted to get your view on the topic of bringing institutional capital on chain. When we go and discuss with traditional allocators, they are still not, at least from point of view of Kirok, not allocating to on-chain products. They're still, even if they want to have exposure to the asset class, they prefer traditional instruments like a regulated fund. What has to happen for that to change, or have you seen already some indications of institutional capital going on the on-chain products?
Gradually, I think we're starting to see some of that flows. I will attribute that to like just improvement in infrastructure across the board, and then the flexibility of strategies within DeFi. Like for example, maybe a couple of years ago, infrastructure like Fireblocks, Anchorage, custodians in general, they were already there, but the understanding of how to utilize these products to interact with DeFi products might not be as sophisticated as it is right now. And I believe like all this key infrastructure that allows for institutional participation have done a great job in user education, which gives like all these institutional users a lot of confidence in using these products to engage with DeFi products. And DeFi products over time has also become a lot more matured. So for example, Maple has been around for years now, and it has proved its resilience in the market. So couple that with the institutional products like custodians, it just makes a lot of sense for institutional users to have the confidence to take part in DeFi.
What's your view, Joe?
Well, I think if you wind back the clock 12 months, we're kind of still in the days of not thinking that President Trump is going to win the election, and to be where we are 12 months later is pretty incredible. And so I think just it can't be underestimated the amount of progress that has been made with the change in administration. I sit in the US, Tian is in Asia, so these are probably very different perspectives. But from Maple's side, as one example, so Cantor Fitzgerald, probably the largest institution that's actively participating in crypto at the moment, launched a Bitcoin-backed lending program. And Maple was the first one to partner with them and access and provide capital into that program. The idea that a DeFi protocol operating entirely through smart contracts on chain would be the first to access a $2 billion facility from Cantor Fitzgerald. If someone said you that was going to happen, they'd call you insane. And so these are just anecdotes that are actually starting to stack up more and more here in the US for institutional participation. You add to this the ETFs, all the capital coming in, as well as then the upcoming Clarity Act whenever that gets passed. And all of a sudden you have the regulatory clarity for institutions to participate, along with the size of capital. We're now at about a $4.5 trillion industry. That means that there's the commercial viability or the commercial reason for them to come in. Does that translate into on-chain activity? I think that's still the next step, right? They have to kind of come into crypto, then come on-chain or into a smart contract DeFi system. But gee, we're making some progress.
That's a great update, by the way. I was not aware of that. Congratulations. Sounds great. When we talk about institutions coming into the space, and I think I've come to start to try to really split between what are financial institutions and what are institutional allocators. There is no doubt in my mind now that financial institutions are trying to make an effort to really adopt the technology, correct? Like from banking institutions, Cantor Fitzgerald, and of the likes. But it's still hard for me to see where is the line between the fact that they are adopting it just because it is a business that it starts to become meaningful enough for them to pay attention to, but that's different than the owner of the capital wanting to allocate to the asset class, correct? And that's the part that is not super clear yet. Why would, let's say, a family office that allocates to hedge funds be interested in allocating to their tokenized version on chain? I don't know if you maybe have looked into that problem and have any view on it.
So we think about it kind of the slope of risk capital, and you start of more institutional allocators, and family offices are the easiest to deal with in turn, and they have made the most progress. So I would say that some of them are doing on-chain activity. They're definitely allocating into crypto, whether that's through VC funds, whether through owning Bitcoin and Ethereum directly, or through the ETFs. And so I'd say in that cohort is where there's the most progress. It then goes out down the risk tolerance curve from there, where you go out to endowments and pension funds and parties like this, where the larger amounts of capital sit. And this is where there's just not that much progress. I think for a very risk-on endowment, that they might have done a few allocations to a crypto VC, and that would be it. So I think we're still a ways away from those parties allocating into crypto assets directly or into on-chain assets. But I think this is where Maple and other on-chain asset managers come in. And so it should be that we're obfuscating away this large barrier or this big crypto risk premium that's perceived by these larger pools of capital. And so that we're creating products, creating experiences that are akin to that they receive and the way that they due diligence any investment that they go into. And so that in a few years' time, whether something exists on-chain and is accessing a product that way, or is still a traditional setup, they don't discriminate between the two because of the quality of professionals that sit within on-chain asset management are akin to the quality that they're dealing with outside of on-chain.
So when they go through this due diligence process, and I don't know the answer, so I'm really interested to get your point of view. What are the key things that you have seen that make them comfortable? What are the questions that they ask you, and the answers that when you give them, you really see, okay, this is great. We can definitely start allocating.
So the biggest thing is the level of education. So you say the word crypto, and you probably just placed a 400 bit premium on whatever you're giving them, right? So that's the hard part, is that if you want to build a legitimate product, you can't have a 400 bit crypto premium built into it. And so this is the divide that exists. Now that premium, I have no actual data on what that premium is, but it, in my head, continues to compress, right? You have this progress of the continued growth of the industry, the ETFs, regulatory clarity. These are all things that compress that crypto premium more and more. And so that we start to get to a point where you can actually issue a product professionally, well risk managed at a decent return that is going to represent an opportunity for these larger pools of capital to come into.
So you don't see a lot of challenges on the infrastructure side, or maybe them digging deep into the smart contract liabilities that are behind. How do they handle that, correct? Because they don't have a lot of experience with that on their due diligence process, or do they?
I mean, T and Canadian, but infra is always the thing, the excuse that we give, right? It's well, it's not because they would allocate if it wasn't for the infrastructure. I don't think that's true. I think if the opportunity is appealing enough to them, and they see it as being strategically aligned and commercially viable, then the operations will sort that out. And so I actually think that we focus too much on infrastructure being the problem or the blocker to this, and not to, well, let's actually give them something that's going to make them money and that's well risk managed. We'll sort out the operations. That's the easy part. And so I think we throw this convenient excuse in rather than making something that's commercially appealing to allocators.
Well, that's actually very interesting. And by well risk managed, what are the things that they look at generally when they, especially let's say, I guess in the case of Maple in particular, what are those elements that give that comfort? Say, okay, definitely very good, very well risk managed, risk return adjusted, it's great.
Yeah, so one is definitely a track record. The second is then having just the way you show up, right? Can you wear a suit when you go into their office, and can you?
Very good.
Yeah, sometimes. I would dust the cobwebs off. But then, are you engaging in a professional manner? Are you providing materials? Are you providing them access to a data room? Is there the level of detail that they can actually due diligence? I mean, these guys hire lots of people to review risk. And so you need to be able to engage, again, in the same way that they would be reviewing any other allocation. And so we've done a good job in beefing out all of these practices, and so that we have these materials readily available to deep dive due diligence.
Tiana, I'd like to get your opinion on this one, just because, in the case of Pendle, I would imagine this being an even harder sell, correct? When you look at a PT somewhere with these very long names going around, first time, everybody gets mega scared. It's what the fuck is this thing, correct? What has been your experience on how to really go through that due diligence process to get people comfortable on large allocations for institutional side?
I want to say we have a lot to learn from Joe. We haven't had to wear a suit and show up in the office in a formal attire.
Good for you.
Yeah, but for us, the experience has been fairly different. Also because I think from product offering perspective, we are more an instrument for these participants to either lock in the rates or speculate on rates. It's a second order derivative after all. Now, when they in the earlier phase, we we have to show, because of the complexity of the product, right? The extent of like contract audit report has to be very elaborate. So sometimes it's not so much what's audited, it's who's the auditor. Can they trust the auditor? So we have engaged for Pendle V2, we've engaged 8 different auditors of like various different background to look through the contracts. That definitely helped convey and instill confidence in the product. And then again, in the earlier phase, what we did was to show up in their office and then book a time, give them an education about Pendle and how yields can be guaranteed if they were to just hold PT or LP until maturity. So little things like that eventually allowed us to cultivate that confidence in the product. But it really took us a long time. For the entirety of 2023, we were basically doing just that, showing up in offices and then giving one-on-one education. So the other thing that I felt was quite important was maybe the first $10-20 million of deposit from anyone was very important because no one wants to be the first depositor. They want to see some level of liquidity in the product before they participate. So it meant a lot to us when we reach out to certain funds and help them understand how our product can be useful for their strategies, and they put money in. And then after 1-2 cycles of maturities, the product worked as intended, and then they started doubling down on their deposit.
It's true that in our in our industry, and now that asset management is going on chain, it's definitely not just the same on chain. Correct? It's a lot more transparent, and it has like a behavior that is very community driven still, even if it's asset management. While traditionally has been a product that is a lot more one-on-one relationship driven and sometimes opaque. Um, how do you think the future version of asset management, the on-chain version of asset management, would differ from the traditional practices? I mean, how is like very interesting to get your view into how the composability elements of on-chain infrastructure and the unique proposition of decentralized finance really makes a product that is not the same tokenized, correct, but something new. And of course, you're playing a critical part into these, but even more than what you're doing at at Pendle or at Maple, what is the overall view that you have in where this is going? Maybe Joe, or you want to start, Diane? Let's do it, Joe.
Sure. So yeah, so I would say that the key is in the word on chain, right? And so the what we're focused on in Maple and what you'll see in our 2026 plans coming up is we want to be defining what the on-chain of on-chain asset management means. And you touched on a few of the key differences. One is the level of transparency. Typically any asset management product is very opaque and difficult to understand what's happening under the seams. You come to Maple, you come to Pendle, you come to any of these DeFi applications, there's a level of transparency because of the on-chain nature of it that just can't be achieved anywhere else. So I think that's like one core thing that's happening. The other is accessibility. And so previously asset management products weren't broadly available. You had to have a private bank set up, you had to have direct access to to professional managers and be of a certain wealth profile and in certain locations around the world in order to be able to access high quality asset managers or high quality asset managed products. And that is eliminated today. You can access Syrup USDC, you can take that to Pendle, you can add in an Athena yield, all from sub-Saharan Africa. And so that accessibility and this being enabled on a global scale is the key difference. And so we want to really reduce that barrier to entry and enable broader access, because this is the potential of why many of us got into crypto is to build a new financial system. And so if we get sucked into the old ways of asset management and only put on suits and look to do it in the old-fashioned way, then we're actually not going to achieve anything. And so it is key that we define what that on-chain portion of on-chain asset management means, and leverage, yes, the benefits and good things that traditional finance do, but bring that into the DeFi ecosystem to then leverage the technology to build out this new global financial system.
100%, I agree. And I think you were mentioning a lot of the access for users. What a lot of people might not also see is that even for the managers, I mean, the cost of running a traditional fund is enormous. The way that the NAVs are calculated and the liquidity events are monthly. A fund with monthly liquidity is already super fast, correct, compared to anything that we have. Where I think on-chain users have gotten accustomed to something that requests a 3-day withdrawal would be outrageous, correct?
Yes. Yeah. Like we run close to $5 billion today, and we have 3 full-time operations people because the system, the smart contracts run everything, right? And so there's no notion of like us reconciling or anything like this. Everything's just happening in real time. And so it enables you to focus on how you're managing risk, how are you continuing to grow.
Joe, I really love this metric, operations personnel per $1 billion. We should start measuring this for every company in the industry.
Yes.
I love it. That's fantastic.
Everyone wants to be going after those tether metrics, profitability per employee.
Yeah, I mean, they are doing well on that, no? What about you, Tien? What do you think?
Yeah, I think largely agreeable with what Joe said. I am also very excited about the prospect of having more forms of yield getting on chain, because that also opens up a lot more, like it opens up more opportunities for people to be creative and coming up with interesting way to generate yield. Like, for example, like these days we are still, I think bulk of the source of yield is still comprised of points and token incentive. And I believe like there will be in like maybe not so long from now, source of yield from like real world assets will become increasingly prominent in the space. Starting with, I mean, we are already seeing money market funds getting tokenized, private credit funds getting tokenized as well, and the yield for these funds, it varies, but the likes of private credit can be as high as like 9 to 10% on average. Couple that with DeFi, aside from just accessibility and improvement in liquidity, I think using these assets and then applying like a very basic looping strategy to something like a private credit yield can also be a meaningful way to generate APY on like this underlying. Yeah, and I just think like this is just like I guess like the super obvious example, but maybe something like a tokenized private equity can be used as collateral on a money market sometime later, and it unlocks liquidity there too. And I think those are very interesting
It's gonna be
assets
hard
that
for
we
you
can.
to strip the yield of the private equity, though. That's gonna be
Well, yeah, yeah. So we might not be beneficiary of that segment of assets, but I think broadly speaking, it really can unlock a lot of value that is currently not accessible and also not that liquid in its current form.
You mentioned like these, this RWA is being tokenized. We at Tier we also just finished a research of the state of tokenized equities, and it's very interesting to see also at the same time the asset managements are going on chain. now the tokenization of more tradable assets within a format that you can build other types of yield through more sophisticated strategies, correct? So you start to have tokenize equities as an asset class that is tradable on chain. Have you guys already started to look into these, and are you planning to work with the different players that are bringing this asset class on chain?
Yes, we are starting to look into it. I want to say because at this stage, a lot of these assets are permission, so they can only be transferred or held by whitelisted addresses. At this point, Pendle is still a permissionless product, so we can only support permissionless assets. So unless these permission assets have a permissionless wrapper that allows them to be circulated without any kind of whitelisting requirements, we won't be able to we won't be able to list these assets just yet. Now, what we do on our end is to also explore an instance to support these permissioned assets, so that we as a V2 product, right, allow users to straddle between the permissionless instance and the permission instance. So there could be arbitrage opportunities between the permissionless and the permission instance. But yeah, that is still in the works.
Okay, interesting. If you look at these assets, at least what came out of our own research, they are started to have actually rather active traded volumes. Funny enough, they are predominantly traded on sexes, like crypto sexes. So these assets are widely traded on the equities sections of the Bybits of the world, and of the likes. Volumes are not daunting yet. They're not at the level as you would imagine, but they're not zero either. If I'm not mistaken, something the last 3 months it was something like 4.5 billion in equities trading on sexes, which is not insignificant, right? It's the first time that has happened. Like before, it was always kind of like a FUD, and it just didn't kick in. And 5% of it is on chain, if it tilts, it actually might get to a point where it becomes interesting for you. I don't know, Joe, if you already started to look into the topic, or you're working with any of the providers on the space.
Well, I think that just to touch on the sex point you made is that for that level of volume to be going through centralized exchanges just shows you how big the access problem is. Like, this is all people that mustn't have a regular trading account or access to the equities market.
They don't have a VKR account, correct? So
yeah. Then one thing that we are conscious of is that there's a lot of talk of tokenizing assets and tokenizing real world assets. And I think it falls into one of two buckets. Either it is these larger assets like money market funds that are being brought on chain, and then there's kind of nothing really happening with them, or it is these long tail assets that are illiquid in the traditional markets and then they come on chain. Both are illiquid things that come on chain on the premise that they're going to get liquidity. Like there's this some like magical spell that happens to an asset that changes its underlying profile, that when it comes on chain it becomes liquid. And I think that is just like completely false. And I think that's been shown now for like the last 7 years that people have been trying to do this. But I think that what is very different is when you bring equities on chain, something that is tradable, something that is underlying actually liquid, and then you bring it into a DeFi ecosystem. And so I think that's why you're seeing that things are actually trading on sexes for when it comes to stocks, that people do want to get access to Tesla and SpaceX and these other things. And so these are things that are liquid inherently in the product, and there is demand for them. And so bringing that stuff on DeFi makes sense to me. Trying to create something that make liquidity out of something that is illiquid makes zero sense. Then for us, we see the opportunity is that our system is built out to enable not just crypto assets to be taken, so not just Bitcoin, Ethereum, Solana to be taken as collateral, but as more institutions move on chain and that becomes part of their business, that we can take a broader basket of assets outside of that, so that it can be digital asset versions of equities or other assets that then can be used as collateral to borrow against. And that's when Maple's doing is at 100 billion AUM. we'll have a significant portion of our business will be crypto-backed lending, and then a significant portion of it will start to be this transformation of the two financial systems starting to come together.
That's perfect, Joe. If you get there before the end of the year, you make our report right. So
Okay. The guys are working.
That's good. Do you accept this in P500 token already? Not yet, probably, but I guess that's the point, correct? I mean, that's going to be very exciting. That's going to be very exciting, and we do see that sector actually growing at the moment in our own research. So that's great. Just to start coming to an end, I wanted to get your view, guys, on what's exciting, not only among the new initiatives that you're launching in your companies, but also what are new primitives and drivers for growth in the space of on-chain asset management. I don't know, Tian, if you wanna maybe give us some insight. We know a lot of exciting stuff is happening at Pendle. I would appreciate your expert knowledge also on what else is happening around.
I very much honestly, I very much look forward to more types of yield, like from real world assets so real world asset getting tokenized, and then their sources of yield to be made tradable through Pendle. That is really an aspect that I'm quite excited about, because once those yield get stripped, I can see so many different types of strategies that can be employed, and then we can get really creative with how they look like. Take aside the risk. Sorry, shouldn't be commenting that, but risks have to be factored in as well. Yeah. I'm also so I believe, like, if anyone can generate sustainable and meaningful yield on Bitcoin, that would be a holy grail. Just because, like, it's the single largest crypto asset anywhere, and so far, like, we've not been able to see meaningful implementations of that. So I'm aware that there are teams that are still experimenting and innovating on this front. But we'll probably have to decide whether they're relevant after they're launched. But broadly speaking, I think these two are.
I can see how they will be very exciting for you, correct? You can do some PTs of
Yes.
Bitcoin. It'll be pretty awesome.
Yes.
I get it. You
Yeah.
might be biased on this one, though.
No, but I like a yield on Bitcoin. Yeah.
Yeah. No, that makes sense. Do you hold the treasury of the company with some Bitcoin yourself? Or
Personally, I do. Company treasury, we have some as well.
no, that's actually great. Maybe before going to Joe, I'm very, very interested to know what's your opinion on the fact that some of the traditional allocators also attribute maybe the lack of what's the name of this solutions to not disclose the trades to the market, and we're not talking about non-disclosure, but there is a lot of people that are afraid of the fact that if they put their strategies on chain, and everything is 100% transparent, they would rather be able to find a middle ground where there is information that is just enough to prove that they are solvent, but not for other people to be able to replicate their alpha. Do you see any innovations in that field that could actually trigger adoption of digital assets, the adoption of strategies?
I'm not sure. I don't have a strong, super strong view here, but I can understand why it might not make complete sense to have the strategies fully transparent. Because if you make yourself so naked, like, there's so many ways like strategies can be exploited. So maybe some sort of like a privacy protocol can help embed that. Something related to dark pool can potentially be implemented.
Many have tried, correct? Many have tried. We don't have yet any proof there is product market fit in that either. Funny enough, a lot of people attribute that these privacy protocols could be exclusive for it, but indeed. Some of them are also coming or starting to grow in that regard. So what about you, Joe? What's exciting? What's coming next?
So big 2026 coming up. So I think the most exciting thing for Maple is that we're now at $5 billion that we're managing overall, and we've been able to really build out a strong 2025. And so what that affords us is the privilege and opportunity to start to take larger bets in 2026. And so we are able to, as I was alluding to before, really create and define what that on-chain portion of on-chain asset management is going to be, and set the standard for the way that asset management should be done throughout the DeFi ecosystem. And so you'll see a report come out later in the year when we announce kind of our 2026 roadmap. But some things to allude to is that we'll be bringing more quality assets to the DeFi ecosystem. So currently our major products are Syrup USDC and Syrup USDT. So we'll be looking to bring other yielding assets into the DeFi ecosystem that still have under the hood the institutional yield generation. And so that's really where Maple sets itself apart, is bringing these core yield primitives that are institutionally managed, that are yield generating, that are consistent into the DeFi ecosystem that then enables things to be built on top of them. And so that's our commitment to the space, and the opportunity that we have in 2026 and beyond, given the amount of growth and capital that we manage today. And so that's what the team's focused on, and you'll see some pretty big announcements and exciting initiatives happening at Maple.
So you're gonna be expecting people to start building asset management, their own asset management and chain initiatives on top of Maple.
No, that will never be our strategy again. I've made that mistake once before, and so we will be creating, managing, and distributing all of our own products. And then the benefit that we get by plugging that into the DeFi ecosystem is that is our distribution, right? So 80% of the capital that comes into Maple today is through integrations, partnerships, and things that are happening on chain, not through people coming directly to the Maple web app and clicking buttons. It's the likes of Pendle, it's integrations into Binance and OKX. It's then other apps and vaults and things that are built on top of the underlying yield. And so what we see, lots of people are working on that distribution and accessing capital. Not enough are working on the actual management of those assets and the underlying yield generation. And so that's the real opportunity for us, is to be that provider on which the entire ecosystem builds out.
That's great. Sounds exciting. I mean, Tien, it seems like Joe is going to be building that Bitcoin product that you want, actually. No, I mean that's what it looks like. That's
yeah. If that happens, like I'll be sure to prioritize the market.
Okay, guys. Well, I think we can close with that. I really appreciate you sharing all the insights. I know that you cannot disclose everything, but we're very excited to see what else is coming your way. At Kirog, you can always count on us also to advise and help on anything related to this topic. We ourselves are working very hard to be an active participant in the digital asset space and support of all of our partners with all of our different liquidity solutions, and now the launch of our own asset management division as well. And so coming next, we'll also be going to the market with new exciting products that might be actually bringing different type of yield that we can all work with you guys to bring to tokenized format. Well, so thank you very much, guys, again, and I'll let you guys have a very, very good day. Okay.
Amazing. Thanks, guys.
Thank you.